Now it's time to jump into what I call the portfolio math or portfolio arithmetic portion of the portfolio management curriculum. So we're going to see this come up in two different readings here. So we'll have part one that's going to go through the basics of standard deviation and the different means and that type of thing. And then we're going to take that and transform it into from what we would call portfolio theory in this reading, and then take on capital market theory in the next, but as you can see, they're part one and part two, so they are meant to go together, I guess. So this is going to be something that has lots of overlap. Other places in the curriculum, you'll see a lot of things we'll see over these next two parts here. The two parts of this reading would be covered in equity, some of it in econ, a lot of it in the quant material. So there's lots of overlap here, and if you looked at this as a complete addition, there would be a lot of formulas and that type of thing. But the truth of the matter is, like I say, you've already seen a fair amount of this as we go through. So let's just jump in and make sure that we understand what it is that we need to know, and sort of try to identify some key concepts or key formulas as we go through. So first of all, talking about return measures. Well, obviously when we're in finance, we're interested in a couple of things, right? We're interested in risk and we're interested in return. Well, typically risk is going to be a measure of volatility. Here we'll see it as standard deviation in a little while. You have already seen that concept in quant methods. But there would be other ways to measure it, and we'll have a portfolio-centric way of measuring beta coming up in not too long as well. But it's going to be some measure of volatility. Okay, now we're going to look at the other side, return, which is going to be some type of mean. So when we look at a distribution of returns, so if we see a distribution of returns that looks like this, well, the center of the distribution, okay, that's going to be, that will be our return measure, right? So what is it if we draw a number of draws from this distribution? Well, what's going to be the typical draw, right? A randomly drawn, if we draw out of this distribution randomly, what is it that we would expect to get? That's return. And then when we look at, how dispersed this distribution is, that's going to be risk. So we're trying to quantify the risk-return stuff as we go through. Now, this holding period return, this is a much used formula across the curriculum. So you're going to see this in a number of places, and it won't, it'll frequently not say holding period return, or it won't be the end of it won't be the solution to the question that you are trying to address. It'll be something you do along the way. It'll also be something that is built into other bigger formulas, and when you can see that as part of the formula, it'll certainly help build your intuition. So all we're looking at here is the return that we are earning over a holding period. So if we buy it on one day and sell it on the next, well, that would be a one-day return. So if we want to annualize that, we got to think about how do we annualize it. We could multiply it by 365, or we could allow for compounding, or whatever it happens to be. Okay, but it's going to be for a return, and the point is, its holding period does not have any time designation. We have to then determine how to interpret that. So it could be from trade to trade. It could be from one day to the next, over the month. It could be a quarter. It could be 6 months. If it happens to be January 1 to December 31, then the holding period return and an annual return would be the same thing. So, this is going to be something that we're going to do a lot of, and you sort of get to where you're doing it without thinking. You'll see it written a number of ways. You can see holding period return written the way it is on the slide, okay, as P1 over P0 minus 1. So that's going to be the holding period return if there are no interim cash flows. We could also see it as P1 minus P0. That's supposed to be a 0. And while it's not necessary to make it all work, I'll put parentheses around that to emphasize that that's essentially a capital gain, plus any cash flow that we've received. I'm going to put it as CF. You'll all frequently see it written as D, divided by P0. So this is going to be, the denominator is our investment. Then we have, what did we get in terms of capital gains? Remember, those could be negative. And any cash flows that we received, I suppose those could be negative as well. And you'll also see it written as P1 plus the cash flow over P0 minus 1. All of those will work for holding period return. And they're all doing the same thing. They're giving us a measure of return over any period. It's just from whenever we designate 0 to whenever we designate 1. So it's relatively easy to do. Anyway, this would be something that I would make sure and have a handle on. You're going to do it a lot as you go through. Next is going to be, well, they're calling it the average return here. I think this is probably better referred to as the mean. So all we will do is add up the observations. So if we've got returns in the first period, second period, third period, out through n periods, you add them all up, divide by n. Well, that is going to be the mean of the sample. And we're going to see that that comes into play in a number of places. So if we have, a return of 2%, a return of 2%, and a return of 2%, we add them all together, we divide by 3, and we find the average return, the average return is 2%, just since all the elements are. We could also see it as 1, 2, and 3. Well, we could add those together and find that the average return was also equal to 2. So the difference is this has no variability. This has variability. So if we're looking at 2% up here and we're looking at 2% down here, well, this is the return side. And the reason it's going to be important that we address both risk and return is because there's a big difference in investing in something like this and investing in something like something that has volatility to it. So the greater the volatility, the greater will be the spread on the distribution. And that's going to be, at least initially, our measure of risk as we go through this portfolio material. Okay, so a geometric return. Geometric mean return is something that I think is a useful construct in finance. So we talk about geometric means. The mean we just looked at would sometimes be called the arithmetic mean. And the problem that we're dealing with is something like this. If you start with $100, right, and you invest from time 0 to time 1, and you turn that into $200, so you have a 100% return in the first period. Okay, and the second period, you go from 200 and you go back down to 100. Well, this is a minus 50% return, right? So if you want to come up with an average return, well, you're going to take 100 plus 50. Okay, so 100% return in the first period, minus 50% return in the second period, and you divide that by 2, so that's going to be 50 divided by 2. Well, that says you have an arithmetic return of 25%. Well, you started with $100 and you ended with $100, and you're saying you're earning 25% per year. Okay? Well, that is okay. In fact, that is the mean. But it doesn't describe the outcome of playing this game multiple times for this particular situation, right? So what we can do if we have a geometric mean is, the difference between the arithmetic and geometric mean. This is the arithmetic mean. The geometric mean will allow for compounding, right? So what we've done here is we've ignored the compounding effect. So when we get minus 50%, it's not being applied to 100, it's being applied to 200. So we could take this as 1 plus 1, okay, times 1 plus a minus 0.5. Okay, if we take the square root of all that and subtract off the 1, don't forget that, then what we would see is we get a 0% return, which is, we started with $100, we had this interim blip, okay, kind of like an internet billionaire, and then they're back to where they only have $100, right? So living with their parents, worth $1 billion, living with their parents again, right? So anyway, so the geometric return allows for the compounding effect. So when you're describing capital markets, you might say that the average return on the S&P 500 from 1920 to 2010 was 12.1%, right? Well, if you had invested $100 in 1920 and left it there for 90 years, so if you said, okay, I have $100, I'm going to invest that for 90 years, so I'm going to multiply it by 1 plus the average return, which was 0.121 to the 90th power, well, you're going to get some big number over here. And then if you went and looked at your brokerage account, or the brokerage account your great-grandfather started for you, put in $100 and let it ride for 90 years in an S&P 500 index, what you would see with this number was way too big, right? It's supposed to say 90. Why is that? Because this is an arithmetic mean. It doesn't allow for compounding. So there was lots of ups and downs. The only time the arithmetic mean and the geometric mean will be the same is if there is no variability, right? So if we have a situation where we've got, 2, 2, and 2, those are the returns we're looking at. Those are supposed to be commas. Okay, well, the arithmetic mean and the geometric mean will be the same. But if there's any volatility, 1, 2, and 3, well, the geometric mean will always be less than, the arithmetic mean if there is any volatility. So that's a good directional thing for the exam, because a lot of times they'll give you, well, I don't know, a lot of times it's possible they'll give you A, B, and C, and they would say, well, what is the geometric mean? And they'll look at this and you'll see the answers are, 2.4, 2, and then something less than 2. I'm going to say 1.x. Well, if they're looking for the geometric mean, if the arithmetic mean is 2, you know it can't be that, and you know it can't be that, it has to be this other answer. So on the exam, being able to eliminate one of the 3 possible solutions is a big deal in terms of getting from 1 out of 3 to where you are 1 out of to where you're 1 out of 2, the 50-50. And if you can, of course, if you can eliminate 2 as being obviously wrong, well, all right, more power to you. So anyway, geometric mean, it's something I think you ought to be on top of for the exam. One other return measure, this is the money-weighted return. Money-weighted returns is nothing but an IRR calculation, so you've seen this elsewhere as well. So IRR is all over the curriculum. Sometimes we call it the internal rate of return. Sometimes we call it the yield to maturity. Sometimes we call it the cash flow yield. Sometimes we call it the money-weighted return. But the calculation is always the same. Okay? And that is, it's just going to be the discount rate, okay, that forces the present value of all the cash flows to be equal to 0. So you can think of this as, investing $100 here, okay, and investing another $20 here, right? So whatever the return was between 0 and 1, you're putting in another $20, and then you're going to take out $160 here. Okay, well, we're going to say, so you've got negative here, you got 160 in the end. Okay, find the discount rate that makes all that equal to 0. That is the internal rate of return. And so it's simply the rate of return that forces the net present value to be equal to 0. So in this case, we have outflows at the beginning. So just like we would in a normal net present value scenario, so it looks common to us. The thing to remember here is that we're weighting by money and not by time. So if you make a big additional investment in the second period, okay, well, then the return between 0 and 1, that's going to have a little bit of money, and between 1 and 2 is going to have a lot more money at stake. Well, this is going to weight toward wherever the most money is in the equation. So it is a money-weighted return is the point. And the notion is that the money-weighted returns do a good job of describing what happens with your portfolio. When you have a lot more money invested, are you still able to have returns that are as high? Make sense? So anyway, so money-weighted return, something that, again, you've seen elsewhere, but you want to make sure you are on top of. All right? Okay, other return measures. So thinking in terms of an investment that we're going to make it to time 0, and it's going to we're going to liquidate it at time 1, or at least we're going to evaluate the return at time 1. So again, we are going to say, well, today's time 0. Here's time 1 in the future. We're going to invest some money here. It's going to be $100. Well, we're going to take some money out over here. It's going to be $120. Well, how do we describe that relationship, the return that is embedded here? Well, gross return is just the return before any management fees. So if this is a gross amount at the end, then we would have to deduct management fees. Net is after we take out management fees. So if we have to pay the managers, 20% of the positive return, so they would take $4 of that 20, so this would only be $116. Well, then net return would be after management fees. We could also think about after tax returns. So we could think, well, all right, if we have a return of 16%, then the government's going to be in there with all 4 feet, so we would have to adjust for tax liability. A real return means that we're adjusting for inflation. So if we sink our $100 in at time 0, and at time 1 we get our money back, well, the $100 at time 1 won't buy as much as it would have bought at time 0. So we have to adjust for the difference in consumption capability. So that would be a real return. And then a levered return simply says, well, you say you invested $100, but did you really put $100 of your money in it, or did you put $60 of your money and $40 of someone else's money? Levered return just means you're looking at the return on the cash that you injected into the process. So let's try an example on this just to make sure that we've got this down. So we have an investor that's going to buy 500 shares at $35 with 50% margin. Remember, this means that they're going to put 50% of their own money in, okay, and that they're going to get a margin loan for the other 50%. So in this case, they're actually going to invest $17.50. So their actual investment then will be 500 shares times 17.5. That's how much cash they're putting in. Okay, the rest of it is going to come in the form of a loan. We're going to ignore interest and commissions in this particular example, but normally we would want to include that as well. After 1 year, the shares are going to be sold for 50. Well, that's good. That's not the way I do my stock investments. I buy for 50 and sell for 35. But this investor is smarter than me, so bought for 35, sold for 50. They were subject to a 15% tax on gains, so we're going to do a tax adjustment. And inflation over the year was a relatively high 4%. What is the real after-tax leveraged return? So we need to go in and say, all right, let's think of what we put into this and what we're going to get out of it. Right? So the real after-tax leveraged return. So what we put in it, what we're going to get out of it, we need to adjust for the tax effect and then adjust for inflation. So the levered return is going to say, look, we're going to have $50 minus $35. We bought the stock for $35. Okay, we're selling it for $50. So this is nothing but P1 minus P0, right? So that's the capital gain. Okay, and this is what we're using as P0, right? Because we didn't put $35 of our money into it. We put $17.50 of our money into it because we borrowed the other half and we're ignoring any interest. When we sold it, of course, we'd have to pay back the loan. So we invested $17.50 and we got a $15 capital gain. Well, that looks pretty good because that gives us an 85.7% return on our cash investment. So our levered return was 87.5. Of course, if you earn 85.7, I think I said 87.5, if you earn 85.7%, well, the government's going to say, hey, that's great, we're glad you did that, we'd like our share. So of that 85.7%, the government's going to take 15%. So that's going to bring us down to 72.8%. And then remember, we gave up $17.50 at time 0, and we got our money back, our $17.50 plus our return at time 1, but it was in cheaper dollars, right? The value of those dollars had fallen by 4%. So we're going to take 1 plus our return, our after-tax return of 72.8%. So 1.728. Divide that by 104 and take off the 1. So because we're adding 1 to the inflation rate in the return, and that gives us our real after-tax return on our leveraged investment of still a very nice 66.2, but that's a long way from the 85.7% that we had before we accounted for inflation and the tax effects. All right. So anyway, so this is a quick little example. Make sure that you can account for leverage. You can think through the idea of margin requirements. You know how to account for taxes. This may have surprised you a little bit down here in terms of the real return. So you don't just subtract off 4% because the 4% is it would be for a whole, right? To what we're saying is that we have decreased our purchasing power by 4%, so we have to divide by 1.04 in order to get down to this 66.2. So hopefully that is all intelligible. Let's keep moving through. So a little bit on major asset classes here. So what is it that you can do? This is the portfolio management section. Well, the portfolio management section is basically deciding which asset classes we're going to invest in and in what weights. So this is intended to give us some view of the a standard list of asset classes. It certainly would not be exhaustive, along with their annual returns and standard deviations. So what you can see is, generally speaking, you've got high returns up here, right? And it goes down to lower returns as you go down the list. And you're going to see that if you have high returns, you also generally have you're going to have more risk with that, right? So high return, high risk, low return, low risk. Generally speaking, this is actually, I think, a little bit anomalous. If you look at long-term corporates and long-term treasuries, the data here is starting to look a little long in the tooth, but nonetheless, you can see that corporate bonds outperform treasuries, which we would expect, but the treasuries actually had a higher standard deviation, long-term treasuries. Yeah, I think that's probably a function of the timing of the data, and if we looked at this over 30 years, you would see a different relationship there. But nonetheless, generally, risk and return go together. So when we talk about portfolio management, the biggest determinant of portfolio returns is asset allocation. So are you going to put a lot of your money up here, okay? Or are you going to be putting a lot of your money down here? Well, that is going to be the biggest determinant of the variation across returns in portfolios. And we have a lot of research out there that shows that. Not that it's any big deal, but most variation comes from asset allocation and not security selection. So, and you can see it makes a big difference. 11.3 versus 3.7. Well, got 40% allocations to small caps or 40% allocations to treasury bills. Well, those are going to be very different sorts of portfolios. Okay, now let's go back and look at this mean variance and covariance and correlation. This is very standard fare for the exam. And I'm not predicting what's going to be on the exam when I say it's almost certain that you're going to use this stuff on the exam, just because it is so embedded in everything else, right? So there may not be a question on calculating variance, but you're certainly going to be thinking through variance and maybe calculating variance and moving between, correlation and covariance and those types of things. It's just part of what we do in finance, so you need to make sure that you are very much on top of this. What we see in the slides here is an approach to what I would call historical data, meaning that we've got 3 years of data for asset A and asset B. We also would need to think of this in terms of probabilistic data. That would be where we have 3 states of the world and probabilities of 30, 40, and 30 or something like that. So you need to be able to do this both ways. The example we're going to do is going to be with historical data, which is probably the more common approach. But make sure that you don't get thrown off because if you move to historical data, to probabilistic data. So looking at this, we have 2 assets, A and B, 3 years of data for each. Asset A, +5, -2, +12 is the return sequence. For B, it's going to be +7%, -4%, and +18. So the first thing we're going to do is say, well, let's calculate the arithmetic means. So for asset A, we're going to take each observation, 5 plus a -2 plus 12. So we'll add all that up and divide by 3. And what we're going to get is that this comes out to 5%. So the mean return for asset A is 5%. Doing the same thing for asset B is going to be 7%. And generally, when you see these return series, the first thing you have to get is the mean. And in order to save time on the exam, they may give you the means at the bottom. If they do that, I think you can trust those calculations. So if we had, 0.05 down here and 0.07, and they said this was the average, right? Then I think you can trust those calculations and you can move on to the next slide. So this is the mean. Now we're going to look at the variance, then the covariance, and then the correlation. So same data. Let's just walk through and make sure that we're all okay with this, right? So remember, asset A has a mean return of 5%. Well, now we're going to calculate the variance. Variance and its cousin, standard deviation, are described as variability about the mean. Variability about the mean. So if we looked at asset A, we could take the 5% return in the first period, and we could subtract off the mean of 5%. Well, that's going to be pretty easy. And then we could take the return in the second period of -2 and subtract off the mean of 5%. And then we could come over here and I'm running out of room, but we could take this 12% and subtract off 5, and that would tell us the deviations from the mean for each of these 3 years. So the deviation from the mean in the first year is going to be 0, obviously. The deviation from the mean in the second year is going to be -7, and the deviation from the mean in the third year is going to be +7, right? So if we did that, and we just did it like that and added it up, well, remember, some are higher than the mean, some are lower than the mean. We're working back towards 0. So we had a couple of options. We could take the absolute value of these deviations, which says, okay, let's take the absolute value of 5 minus 5. Well, that's going to be 0. The absolute value of -7, that's going to be 7. The absolute value of 7, that's going to be 7. We could, in other words, use the absolute deviation of these of each outcome from the mean. But an absolute deviation is a perfectly fine measure of variability. It is getting at the same thing as what we're calculating here, variance and standard deviation. The problem is it doesn't have very nice mathematical properties. It doesn't work and play well with others. So what we're going to do is we're going to square each of these deviation terms. Why? Because when you square it, that makes them all positive. And then, of course, we're going to have to divide this by n minus 1. So we have 3 observations in our sample, and we're going to lose a degree of freedom here, essentially. Because we're working with a sample, if this were a population, we would just divide by 3, but it's not. It's a sample, so we're going to divide by the n minus 1. And when we do that, that's going to give us the variance. Okay? In this case, the variance is going to come out to be 49. Well, the trouble with the variance is we've taken the deviations from the mean and squared them. So this is a measure that is in units squared. Okay? So when do you use units squared? Well, if you're talking to a high school girlfriend or boyfriend and you're talking about how much money you make, then you may use units squared. But normally we don't walk around using units squared very much, right? So in order to get this back into our original units, we're going to calculate the variance, the deviations from the mean for each observation squared, divide by n minus 1, and then take the square root to get back to the original units. So the way we would think of this for asset A is it has a mean of 7, and in this case it also has a mean of 5, and a standard deviation of 7. So really quickly, to think about interpretation, if we were doing this as a normal, right, so we'd say, look, all right, this has a mean of 5% and a standard deviation of 7. So if we came up here to added 7, so to plus 1, standard deviation, so this would be 12%. And we came down here to minus 1 standard deviation, so this would be minus 2%. Right? This is plus 12%. So I have to put the percent signs in to minus 2 if I did that right. And then in this range, right, we would expect to see about 68% of the observations. And if it was truly normal, we would see 68% of the observations. So if we draw out of this repeatedly, 68% of the observations in a repeated draw from this distribution will be between a minus 2 and a plus 12. So if we wanted to form a 68% confidence interval, well, a 68% confidence interval for this would be minus 2 to plus 12%. So if we went down here to minus 2 standard deviations, right, and up here to plus 2 standard deviations, well, in that range we would expect to see about 95%. And even if it was normal, it would still be an approximation there. It would actually be about 96%. So if you wanted to get exactly 95, you would come out in a normal distribution plus 1.96 down here to minus 1.96, which that's the number that keeps showing up in your quant method stuff, 1.96 when you were doing t-tests. That's where it comes from. In a normal distribution, if you go up and down 1.96 standard Ds, then you'll have 95% of the data in that interval. So anyway, so that's how to interpret mean and standard deviation. So the mean is the center, and the standard deviation tells you how far afield everything else goes. If we looked at the other distribution, which I didn't note its variance when I came to this slide, but it would be 7, so its mean would be higher, but its standard deviation is also higher. So you're going to have to add something bigger than 7. You're going to have to come way out here. Well, the more spread out the distribution, the bigger the standard deviation and the wider the interval you're going to have in order to contain the same 68% of the data. All right. Okay. So and what I needed, the number I needed there was 11. So we'd have to take 7 and add 11 to it. So in order to get a 68% confidence interval, or contain 68% of the data, we would have to take the mean return, which was 7%, and add 11 to it. So that would be 18%. And then we'd take the 7% and subtract 11. So that'd be what, minus 4%? Well, in that range, we would see 68% of the data, whereas we only needed to go from 12 to minus 2 when we were looking at the distribution of asset A. Make sense? So the point that I'm making there, and probably I have the sense that I didn't make it very clearly, so I'm going to restate, is, look, the smaller the standard deviation, the lower the risk. So it's the difference between having a distribution that looks like this, okay, where you've got something centered at 5 and you've got some standard deviation, and something that looks like this, right, where it is centered at 7, but you have the distribution much more spread out. So this is return, and the spread, the standard deviations, what's measuring the spread, is going to be the way we denote risk for the portfolio management stuff, and generally in finance. All right, so what we've done is we calculated the mean. Okay, now we've calculated the variance. Let's move to covariance. All right, so covariance and then covariance to correlation. So when we wanted to look at the covariance of returns, well, covariance is essentially asking how two number series vary together. So, and this could be anything, right? So it could be, you know, we could look at sunspots and yak milk production, okay, and we could see how those things covary. But what would be interesting in finance would be to see how, you know, inflation and, you know, interest rates vary, or interest rates and the value of a bond, or the return on security A and return on security B. So it's just a measure of how these things vary together. So we're working on covariance here. The problem is that it is unbounded, right? So its maximum would be plus infinity, and its minimum would be minus infinity. So it ends up being a number that is difficult to interpret, right? And what we're really asking ourselves when we calculate covariance is the simple question of whether these things tend to be above their means at the same time and then below their means at the same time, or are they moving in opposite directions? When one is above its mean, the other is below its mean. So instead of taking this, if we're looking at asset A, we took, you know, forget that. We took 5, which was the return in the first period, and we subtracted off 5, and then we squared it, right? So that was to give us our deviation squared for the first period. Instead of squaring it, we're going to take the deviations in the first period, and we're going to multiply it by the deviation for the first period for the second number series. In this case, the returns on asset B. So that's just going to be 7 minus 7. In this case, it ends up being 0 times 0, so it's fairly uninteresting. But in the second one, we could have minus 2 minus 5, right? So that would be minus 7, and instead of squaring it, we're going to take it and multiply it by the deviation the deviation from the mean for the second period for the other number series, which is going to be minus 4 minus 7%, right? So in this case, we're going to have we can have I guess 3 things happen. We can have a positive deviation for one times a positive deviation for the other. Okay, well, a positive times a positive is going to equal a positive, right? We could also have something that was below its mean, right? That would give us a negative deviation for the first number series. Multiply that by a negative for the second number series. Well, a negative times a negative is also a positive. So if these things are both above their mean, we're going to get a positive number out of the product of the deviations. And if they're both below their mean, we're going to get a positive number from the product of the deviations. But we could have one that was positive and one that was negative, and then we would get a negative product, right? So variance is going to be increasing when these things are above their means at the same time or below their means at the same time. So that would be they're moving together. Or it's going to be, the impact of the calculation anyway, would be that it's going to reduce the calculation if we have it offset, right? If one of us positive deviation, the other's negative, or vice versa, that's going to tend to make the covariance negative. So when we look at this, what we're really measuring is the magnitude, okay, the magnitude and linear association of when these things are above their mean together and when they are below their means together, right? So, or are they moving vice versa? So we take this, okay, well that's 0, so that's going to be positive, and this is going to be positive. So in this case, we end up with this positive number. Of course, you have to divide by n minus 1, of course. And it's actually 0.0077 because we took all the zeros out of the calculation here. So the covariance here is 0.0077. Now, that's great, right? That is, in fact, the covariance of this series of returns. Returns on asset A, returns on asset B over these 3 years. But what does that mean? Well, it's positive. So I know that that means that these things tend to move together. When one's above the mean, the other tends to be above its mean. When one's below, they tend to be below the mean. But I don't have a good handle on exactly what that's telling me. I know that there is less tendency to covary if it is 0.0077 than if the calculation had produced 0.0078. Well, the higher the covariance, the greater the tendency to covary, okay, but I don't have any idea how to interpret either of those numbers, right? So I know the covariance is positive. There's times I can use the covariance in other calculations that do mean something to me, okay, but just seeing that we have this positive covariance of 0.0077, okay, I know that they tend to covary together, but I don't know anything about the strength of that just from looking at that. However, what I can do is I can move to correlation. So we have this covariance, which is bounded by positive infinity and negative infinity. It's stated in the units of observation. Okay, well, let's move to correlation, which is directly interpretable because it is unitless, right? And it is bounded by -1 and +1. So this, I think, is a really valuable formula. So when I get ready for the exam, or was getting ready for the exam, I had 2 formula sheets. They were actually side by side. But anyway, I had what I thought of as really important formulas and then other formulas. The formula for covariance, I think, is something that you ought to know. But this, the relationship between covariance and correlation, I think is something that is very common on the exam, shows up in a number of places, and something you'd want to have a handle on. So if we take the covariance of returns and divide it by the product of the standard deviations, right? The covariance divided by the product of the standard deviations, that's going to tell me what the correlation is. Okay? In this case, of course, we rigged the game, but we take 0.0077, divide it by 0.07 times 0.11, that's the product of the standard deviations, and we find that these things are perfectly positively correlated. Okay, so this correlation thing, this is one of the mother concepts in finance, certainly in portfolio theory, and we're going to find that this is, of course, the driving variable in diversification. So that's coming up in just a little while. But understanding correlation is really important. Okay, so if we have +1 correlation, those things are perfectly positively correlated. They move up and down, at least by some linear function, perfectly together. -1 would mean they're moving exactly the opposite direction. 0 means there's no linearly identifiable relationship between the two. And then we could have imperfect positive, that would be 0.3 or 0.5 or 0.7. And we could have imperfect negative correlation, -0.3, -0.5, -0.6, something like that. So on this continuum from -1 to +1, +1 is going to have a special place in the diversification annals, okay? And -1 will also have a special place. Neither of them are important in practice, but they're both good for anchoring your intuition, because this one is going to allow for no diversification, and this one would allow for perfect diversification, as we'll see in a little while. All right? Okay, so mean variance, standard stuff. Covariance, okay, you need to make sure you can do that. But then the move from covariance to correlation and vice versa, that's something you want to know. Make sure that you understand that, of course, if we had the correlation, we could move back to covariance if we needed it. There seems to be a tendency that if you need correlation, you get the covariance. If you need covariance, you get correlation. So those interim calculations, make sure you know what data you're working with. Be careful with simple transformations. Covariance, correlation, retention ratio and the payout ratio, standard deviation, variance, anything where there's a simple transformation from one to another. Make sure you identify in your head, oh, that's the variance. If I'm going to calculate it, I need the standard deviation, so you got to make sure to take the square root. All right? Risk aversion. Hey, don't misinterpret risk aversion. Here's the way to think of it. We can have differing levels of risk tolerance, okay, but everybody is risk averse. Right? So risk aversion just means that we prefer less risk to more. So if two investments have the same expected return, right? We're going to earn 8% either way. Then investors prefer the one with the lower risk. If they have the same risk, so either way we're going to have an 8% standard deviation, and we really believe that's the right measure of risk, which is a whole other story. But if the two investments have the same risk, we want the one with the higher expected return. So we are not simply worried about risk minimization. Okay, we are worried about optimizing the risk that we're taking, and so we have to trade off risk and return, and that's what we're headed to with portfolio theory. Okay, really important here in terms of formulas and understanding for the exam. So this is the equation for the variance of returns on a two-asset portfolio. Now, this formula actually comes, if you're a programmer, it comes out of a double summation. So, you loop through one thing, you have one loop, and you loop through the second one until you finish it, and then you go back and you have to loop back through again. My point being that this is for two assets, right? So this was stock A and stock B. So the weight of A, right, and the weight of B. If we went to three assets, the formula would get a lot longer. If we get to four assets, it's going to really get a lot longer. The point being that as the number of assets increases linearly, then the size of the formula increases, I guess it's geometrically. I don't think it's exponentially. So anyway, increases geometrically. So you don't have to worry about the variance of return on a three-asset portfolio. All you need to do is understand the intuition that's coming out of this. So this formula is, this is actually the way I think of it. Okay, so it's going to be the variance of A times the weight of A squared plus the variance of B times the weight on B squared, 2 times WA, WB, the correlation, and the product of the covariances. Notice that this, okay, is simply the same as the covariance AB, right? We just saw that 2 slides ago. So we had covariance, we wanted to calculate correlation, we took covariance, divided it by the product of the standard deviations. So if you solve that for covariance, you get correlation times the product of the standard deviations. So the formula has this covariance term at the end. I like to write it like this and just remember that that is going to be covariance if they gave me the covariance directly. So what is all this telling me? Well, again, what's going to happen here is if this correlation coefficient is equal to +1, right? Well, if we have a 50-50 weighted portfolio, so that is the weight in A and the weight in B are both 50%, then if we looked at the standard deviations of asset A and B that we just finished working with, and it seems like the standard deviations were 7 and 11, right? 7 and 11%. Well, if we added those two things together and divided them by 2, okay, we would get 9%. Did I do that right? So we would get a standard deviation, an average standard deviation of 9%. So if assets A and asset B are perfectly positively correlated, which in our case they were, okay, then we could plug in all of this stuff, and what we would get over here would be that when we took the square root of this, okay, then it would be equal to 9%, 0.09. So if correlation is +1, then you're going to get the average, the weighted average of the standard deviations of the individual assets. But the point of this is to note that if this correlation is anything less than +1, right? If it's anything less than +1, then what we're going to get for the standard deviation of the portfolio is something less than the average standard deviation of the individual assets. Okay, so if we plug this in for a normal relationship, we will plug in something like 0.3 or minus 0.3 if we're lucky, and what we're going to see is that this is what's going to give us the variance, and then take the square root to get the standard deviation. So when we do that, we're going to find that the risk of the portfolio is less than the average risk or weighted average risk of the individual assets. So this is the term that brings the element of diversification into portfolio analysis. So you need to be able to work with either of these. I like to write it like this. Let me point out a couple of things just to keep you from making some arithmetic errors. Make sure you practice this once. You're looking at the formula, you're saying, well, if I have those elements, I can plug in, but just just do a calculation to make sure you're on top of it, because remember, these are standard deviations over here, these are variances. These are weights and these are weights squared, so you have standard deviation and variance in the same formula, and you've got weights and weights squared in the same formula, so you got to be a little bit careful as you're going through this. It just seems to be something that gives people more trouble than what they were expecting. Anyway, formula for the variance of a portfolio, I would say that's definitely something that you would want to know as you head into the exam. So, as a quick application, a portfolio is 30% invested in stocks, okay, which have a standard deviation of 20%, with the remainder in bonds, standard deviation of 12%. The correlation of returns is 0.6. What is the standard deviation of returns? So we have the weights of 30 and 70, right? 30% in one, everything else has got to be somewhere. Got to have 100% allocated to something. So 30% in stocks, standard deviation 20, 70% in bonds, standard deviation 12, correlation coefficient of 0.6. Okay, well, if we plug all that in, so here is our standard deviation. Here's our weight squared, not standard deviation. This is our variance, because it has a squared term, times the weight squared. Variance times the weight squared, 2, weight 1, weight 2, correlation, and then standard deviations here. Take the square root of all that, and we get 12.9%. So an important thing to note, and I know I talked about it on the last slide, but it is a fundamental insight for portfolio theory, is to recognize that if we just said, look, we've got 30% of our portfolio in stocks, so let's take 0.3 times 20%, okay? And then let's take 0.7 times 12%. That would give us the weighted average standard deviation of the individual assets. Okay? And if we did that, and the calculations down here, it comes out to be 14.4. Well, 14.4 is the highest that the standard deviation of the portfolio can be, and that would only happen if the correlation was equal to 1. Given that the correlation here is less than 1, we know before we ever do a calculation, okay, that the standard deviation has to be less than 14.4. Right? So if I was looking at the exam and I said, what's the standard deviation of this portfolio? And it said, well, is it 15? That's not a good. Is it 15.2? Is it 14.4? Or is it 12.9? Well, let's see. If I just in my head did a real quick calculation on the weighted average of the standard Ds of the individual assets, I'd get 14.4. So I would know that couldn't be it. I would know that it couldn't be higher than that. It's got to be lower than that. So again, that would be 12.9 would be the only logical answer. So anyway, the point is that when we combine these assets into portfolios, okay, if the correlation is anything less than 1, then the standard deviation of the portfolio will be less than the weighted average standard deviation of the individual assets. All right? So let's see how this works. So this is actually getting now into what we're thinking of as portfolio theory. So let's suppose we have two assets, stock A and stock B. So here's A up here, here's B down here. Well, if those two things are perfectly positively correlated, what's going to happen if we put 50% of our money in one and 50% of our money in the other? Well, the free lunch of portfolio theory is usually that you don't add together risks, but you do add together returns. Okay? And so what that means is, look, we have some return for stock A that's over here, and it looks like it's a little over 10%. And stock B looks like it's about 3%. Well, if you combine those in a portfolio, you're just going to end up in the middle, right? 50% of one, 50% of the other. Well, the return is always going to be a weighted average of the individual assets. And if the correlation is +1, then the risk will also be a weighted average of the individual assets. Okay, so that would say if we were all the way down here, well, that would be 100% in stock B. That's our risk-return combination. Okay, so we're in the risk and return space. And if we're all the way up here at stock A, then that would be our risk-return combination. But anywhere in between, 90% A, 10% B, 50-50, whatever it happens to be, is going to lie on this straight line. All right? So this is if we were in the middle here, then it would just show up here. That's a 50% A, 50% B, and the return would be over here. It looks like, at 7% or something like that. So if you don't have any diversification benefits, that is that correlation is equal to +1, then the portfolio combinations of A and B will just lie on this straight line. Now, in the real world, there are no perfectly positively correlated assets that both have positive expected returns. We could have some derivative stuff that would be perfectly positively or perfectly negatively correlated. But if you pick any, think of this as stocks. So if you take Microsoft and you take something that's closely related to Microsoft, right? Selling into the same market, whatever it happens to be, then okay, so those things are going to be highly correlated. They may have a correlation coefficient of 0.7, but it's not going to be perfect correlation, right? So anytime the correlation is less than +1, you're going to get to see, or going to start to see diversification benefits. And those diversification benefits are going to be represented by this bow in our relationship between the two. So if we wanted to combine portfolios, 50% A, 50% B, and they were positively but imperfectly correlated, correlation coefficient of 0.3, well, then what we would see, okay, is we'd be right over here, right? So we would have the same return. The lower correlation doesn't impact return, but what's happened to risk? We were up here, and now we're down here. So as the correlation falls from +1 to 0.3, right, from perfect to positive but imperfect, we start to see this bow. Well, and then what if we could find some negatively correlated assets, right? So if one is Microsoft and the other is a gold mining company or something that's counter-cyclical. So anyway, so then if we had minus 0.3, well, the bow would get even bigger, right? And we'd say, okay, now if we combine them, we're going to be over here. Same return but lower risk. And then we could keep pushing this, and in the limit, what we would find is that if we could find perfect negative correlated assets, then we could take two risky assets, okay, perfectly negatively correlated, but both risky assets, and we could create a risk-free option, right? And there's a formula for telling us exactly what the combination would be, and we don't have to worry about it here. And it's not important anyway, because just like there are no perfectly positively correlated assets, both of whom have positive expected returns, okay, there are also no perfectly negatively correlated securities that have positive, all that sort of stuff. So anyway, so you're not going to find fundamental or naturally occurring securities that are either perfectly positively or perfectly negatively correlated. So we're always going to be in the middle, so we always have at least some diversification benefits, right? So even if they're, small, there's still going to be some diversification benefits because there's always, the correlation is, other than academic examples, are always going to be but lower than +1 and higher than -1. All right? So this is the idea of diversification. The lower the correlation, the greater the risk reduction. Right? So the lower the correlation, the greater the risk reduction. Okay? The other way to say that is the lower the correlation, the greater the diversification of risk. And remember, it doesn't impact return. Return is just a linear combination. Okay? Weighted average of the individual assets. All right? Okay, so important concept. Let's try it now in terms of portfolio stuff. So here's what Markowitz won a Nobel Prize for. It looks relatively simple to us today. That's because we've been staring at it since the 1960s. So if we're looking in the risk-return space, what he did this, of course, analytically, that is with the math, and then and verified it empirically. But if we had these individual assets, and we say, okay, let's find the risk-return combination of individual assets. What you'd find is the returns were low. Maybe I ought to get them a little higher here. As well, returns would be all over the map, but the risk would be really high, right? So that's total risk. Well, then he said, let's take those and let's take and randomly choose two assets and combine them into a portfolio. Well, there's two assets. I circled them. Well, what is the correlation between those two assets? I don't know, but I know it's less than perfect positive, right? So we're going to get some Boeing effect here in this portfolio. So if we combine them into a portfolio, we're going to get a better option. And we do that with all of these things and come up with pairwise comparisons. Well, then we're going to get some portfolios up here, right? And then if we say, well, let's take those two asset portfolios and combine them into four asset portfolios, we're going to get something up here and like this. And finally, what we're going to get is we're going to push and we're going to see that we have this frontier, all right? So this frontier, these are the best portfolios that money can buy, right? And that's because they have the high, if we look at this point, this portfolio has the highest return for this amount of risk, right? Or it has the lowest risk for this amount of return. So that's true of this portfolio, it's true of this portfolio, it's true of this portfolio. Now this part under the curve, well, those are in some sense the worst portfolios you can combine, so we're really only interested in it from the point of this bow, and this is the global MVP, minimum variance portfolio, which has become kind of a hot item in some money management circles. But anyway, so the MVP, we're really looking at this section of the curve up here. That is called the efficient frontier, and that's what Markowitz did. This is modern portfolio theory. All right, so with very limited artistic ability, this is modern portfolio theory. And all that says is, look, we have this opportunity to combine risky assets to come up with optimal diversification. So the minimum variance frontier, or the efficient frontier, sometimes called the risky asset, which is a kind of a clue of what is to come. The risky asset efficient frontier. Okay, well, that's this part of the curve, and that's basically when we talk about the mean variance optimization or mean variance diversifiers or Markowitz efficient diversifiers. All of those mean that we are assuming the investors are somewhere on this curve because those are the best options available. So if we look at any point, we can describe it in two ways, right? So each of these dots that I'm drawing here, okay, it would be true to say they offer the highest return for a given amount of risk, right? So if this is the amount of risk you're going to have, this is as much return as you can get. You can get lower returns, but you can't get higher returns. Okay, they also, for the highest return for a given amount of risk or the lowest risk for a given amount of return. So if we're coming over here and say, well, here's the amount of return, well, that's the lowest risk we can get, right? If we insist on that much return, we can't have any risk lower than that. That is why it is an efficient frontier. So again, just from this minimum variance portfolio up. All right, so that's the idea behind Markowitz. And what we can do then is think about, all right, so this is the risky asset efficient frontier. What can we do with that? Well, if we just looked at it like this, and we'd say, well, no, this looks like a good combination for me because I'm old, and this looks like a good combination for you because you are young, and this looks like a good combination for that person down the street that's not very smart, or something like that, right? So anyway, so we can choose our optimal trade-off based on our risk return preferences, life cycle position, all that type of thing. Okay, but there's some other things we can do with this, obviously. All right, so the efficient frontier, the frontier is the set of portfolios among all the possible portfolios that contain risky assets that have the highest expected return for each level of risk. So that's what I was just saying about each of those points. So let's talk about two other things here, and then we will call it good for part one. So this is a capital allocation line. Right? And a capital allocation line simply raises the specter of having a risk-free asset. So remember, 2 slides ago I said, oh, this is sometimes called the risky asset efficient frontier. Okay, what we're doing now is we are adding a risk-free asset. Okay, and this capital allocation line simply says this. Right? So if we're looking in the risk-return space again, okay, well, we have a risk-free asset. Okay? And so what's the standard deviation of the risk-free asset? Okay, well, the standard deviation is equal to 0, right? What is the covariance of the risk-free asset with any other asset? Well, it's also equal to 0, right? No variability, then the covariance is, with all other assets, going to be 0. So if you go out and you choose your best portfolio, so you go out, you're a stock picker, you find all the undervalued assets, and you come up with this portfolio. So, all right, there's your risk. Okay, so that's whatever it is. I'm going to call it risk sub P, and here's your return. So this is going to be the return sub P, right? So that is your best portfolio, and you look at that and you say, wow, that's really great. I worked hard to generate that, but it has a standard deviation of 25%, and that just seems too high for me. So I'm going to have to do something else. Okay, well, here's the point. If we take any risky asset or any risky portfolio, okay, and you combine it with the risk-free asset, well, the fact that the risk-free asset has 0 variance and 0 covariance with all other assets means that combinations of the risky asset or risky portfolio and the risk-free asset will fall on a straight line. So if we did 50-50, we would be here, right? If we did 25% in the portfolio and 75% in the risk-free asset, we'd be here. And if we reverse that, it would be here. So we can create any portfolio along this line. Okay? Then if we look at that and say 25%, I'm young, handsome, 10 feet tall, bulletproof, invisible, I got to have more risk than that. Well, what we could do is we could short this, that is we could borrow money, short the risk-free asset, borrow money, and we would get something that looks like this, right? So the point here is if we have a risk-free asset, right, something that has zero variability, zero covariance with everything else, or at least close to that, so we can proxy that with T-bills, then we can create from the combination of any risky portfolio and the risk-free asset, we can form this CAL, which stands for Capital Allocation Line. And what we're going to do is instead of having one point to choose from, we can choose any of the portfolios on this spectrum. So the capital allocation line just creates the straight line relationship between the risky asset and the risk-free rate. So this is a CAL. So here's our risky asset up here. Here's the risk-free rate down here. We've got our CAL, and we say, look, that's just too much risk for me. I want to be over here. What's the risk of that portfolio? Well, the return is going to be, so this looks like it is what, 60% in the risky asset, right? And the other 40% is going to be in the risk-free rate. So we're going to have 0.6 and 0.4. Well, if we multiply 0.6 times the return on the portfolio, I guess portfolio A is what we should call it since they do in the graph, plus 40% times the risk-free rate, right? Well, that's going to give us the expected return of this portfolio. So it's going to be over here, right? And if we wanted to do the risk of it, it's simply going to be 0.6 times the standard deviation of A. That's the end of it. That is the risk of the portfolio. Why is that? Because we could take 0.4 and multiply it by the risk of the risk-free asset, RF, and then we could do all the correlation stuff, but the correlation's zero, so that big long term at the end is going to fall off. Okay, when you think of the two-asset portfolio formula we looked at 4 or 5 slides ago, and this is equal to, so all this stuff goes away. So the risk is simply going to end up being whatever portion we have allocated to the risky asset times the standard deviation of the risky asset. So that's how we get on this straight line and on the CAL. Once we take the CAL, we look at that and we say, well, okay, I can have 100% risk-free, I can be 50-50, I can be 60-40, I can be 100% in the risky portfolio, I can be 120% in the risky portfolio. How do we choose where we are? Well, we use indifference curves, all right? So an indifference curve, also called an iso-utility curve, which is a long name, but I think it is a good one because it tells you exactly what's going on. So what this is saying is that for investor A here, for investor A, they are equally happy at any point along this line, right? So their portfolio combinations, anywhere there, they get equal utility. They would also be equally happy at any point on this line, so this would be the IA prime, and any point on this line and so forth. So the indifference map has to be everywhere dense, which means that every point has to be covered. But what you want is you want the point of tangency between the investor's highest indifference curve and the CAL, right? So getting rid of some of my chicken scratch here. The reason that this is chosen, this particular indifference curve, is because it's the highest possible indifference curve that has a point of tangency to the CAL. And if you'll think of it, you look at the slope of this. Well, this says, look, this investor is going to be equally happy here or here, right? But notice the steepness of the curve. That means to compensate this investor for taking more risk, you're going to have to give them a lot more return. Whereas over here, well, there's going to be a smaller spread between risk and return, meaning that investor B is less risk averse or more risk tolerant, would probably be a better way to say that, so that they end up choosing a portfolio here that has higher risk and higher return. Investor A, lower risk, lower return. So the level of risk tolerance of the individual investors would be revealed in their indifference curve map. And you're looking for the indifference curve for the investor that is the highest feasible curve, the one that's just tangent to the CAL. That would be the portfolio you would choose. So all you have to do, if you want to be a great investor, is go out and find a really great portfolio, take the risk-free rate, form your CAL, and then get out a utilometer, stick it next to your arm, and and calculate your utility from all these different portfolio calculations or combinations, and then you could choose the optimal portfolio given that that was your information set. All right? Now, of course, I'm being facetious about that because it is not, we don't have utilometers, and these indifference maps are really hard to identify for individuals. But the point is to say, look, once we've created this Cal, this becomes, if this was created from our, what we thought was our best risky portfolio, then that becomes the efficient frontier, the straight line efficient frontier. And if you and I have different risk preferences, okay, I would be down here because I'm old, close to death, and you would be up here. You're younger in the life cycle, so you're willing to take more risk in the hopes of earning more return. Me, so you're still buying materials to build your rocket ship, so you're up here, you're going to have lots of risk and you're going to get high returns. I've taken the materials that I bought to build my rocket ship and I'm building a bomb shelter, so I'm going to have lower risk, lower return portfolio based just on life cycle influences. Okay? So this is going to end up being a really important part, integral part of what we're going to talk about in the next little reading, which is going to be essentially moving from portfolio theory to capital market theory.